Hey guys, welcome to Pounds Invested. I'm your host, Stephen Georgiev. What if I told you that there was an investment which you could set up in under an hour, which would allow you to profit long term? Would that seem too good to be true? Well, I've got good news for you. It's not. Such an investment exists. It's one of my favourite kinds of investment. I'm talking, of course, about index funds. Before we get into what an index fund is and why they're a great investment, be sure to smash the like button. Now that you've done that, let's get into index funds. So, what is an index fund? The best way of explaining what an index fund is to say it's like having a piece of 1,000 companies in your basket. So why is it a good idea to own 1,000 companies rather than just one company in your portfolio? Well, I mean, sure, you could be one of the really lucky ones who bought Tesla over the past year and then watched it shoot up in value. Alternatively, you could be one of the really unlucky ones who bought what was at the time the UK's second biggest government outsourcer, Carillion, a household name, which of course is no longer around. And so by buying tiny pieces of hundreds of companies, what you're doing is you're limiting your downside risk to any one of these companies going bankrupt. But isn't all this expensive? Well, actually no, not really. So you can own a piece of hundreds of companies through something as simple as a Vanguard index fund for as low as a few £100 per unit. So rather than owning 0.00001% of one company, what you own is a unit of a basket of companies. So what are the advantages of an index fund over single stock investing? Well, one of the biggest advantages of an index fund is its low fee structure. In addition to that, it's really easy to put together. You can almost set it and forget it, and then only check in with it once every month or every couple of months as you feel comfortable. And this is what's known as a passively managed investment fund. What's the alternative? Well, the alternative is what's known as an actively managed investment fund. This is where a company pays the best and brightest minds it can find hundreds of thousands of pounds per year in an attempt to outperform the market. But there are a few issues with this active management approach. One is that they don't really work very well. So as we can see, 90+% of super smart hedge fund managers and investment managers don't actually manage to outperform the wider market over a long-term basis. And what do you get in exchange for a fund manager's best efforts in an attempt to outperform the market? Well, unfortunately, you probably don't get very much. What you're normally left with is higher fees which get passed on to you because, of course, the investment company needs to be able to afford to pay the investment manager their hundreds of thousands of pounds salary per year. All of this, remember, with no guarantee of any outperformance of the market. Let's compare their performance. Well, we can see that fewer than 10% of actively managed funds beat the market in any given year, never mind over a 10-year period. So what that means is 90% plus of the time you'll actually get a better return with your index funds than you will with an actively managed fund portfolio. So if 90% plus of the smartest of the smart fund managers fail over time to outperform the market average, then I, as an individual investor, have no reason to try to think that I'm better than them. Now, let's break that down a stage further. Well, as we can see from this particular graphic here, one problem that individual investors often face is the emotional aspect of investing. They'll often see an investment increasing in value and jump into it. Then they'll hold it for a bit, then of course it'll reach its peak and start decreasing in value, and then they'll panic and they'll sell. In fact, Warren Buffett demonstrated this exact scenario some years ago when he made a bet with the fund managers of Wall Street. The premise of the bet was that Warren Buffett had no confidence in the fund manager's ability over the following year to outperform a basic investment in an index fund. And, spoiler alert, Warren Buffett won the bet. So if the sixth richest person on the planet is willing to bet $1 million of his own money against super smart fund managers, and then he comes away a year later having won the bet, I'd say that gives credence to the argument that investing in a basic plain old index fund is going to be what's going to leave most retail investors better off in the long term. One other benefit of investing in an index fund is, of course, diversification. So rather than investing £100 in 10 companies, what you're doing is you're investing £1,000 over sometimes 500 or maybe even up to 1,000 companies. So let's say you invest £1,000 across 10 companies and one of them goes bankrupt, like for example Carillion did a couple of years ago. The £100 that you've invested in Carillion, you've lost, it's disappeared, it won't come back, because it was invested in a company that no longer exists. So contrast that with investing your £1,000 in an index fund made up of 500 companies. Now, if one of them goes bankrupt, you haven't suddenly lost 10% of your entire capital. You've maybe lost 2% of your entire capital, and that's recoverable in a good trading couple of weeks. Like we alluded to earlier, one other big advantage of investing in index funds over investing in individual companies is that a lot of investors who invest in individual companies tend to let emotions run wild. So if I invested in an index fund with 500 or 1,000 companies, I've no need to start waking up at 3 AM wondering about a financial disclosure the following day, or whether or not I've correctly understood a balance sheet item on a company's financial statements. All of the emotion of the investment is taken entirely out of the equation. Again, this is simply because I don't need to worry about any individual company in my investment portfolio, just because it doesn't really matter what any single company does. Now, one final benefit of investing in index funds over investing in single stocks is all the time you save. By investing in an index fund, you don't need to spend hours or days poring over the finer details of an individual company's financial statements, which, let's be honest, you might not really have a full grasp of anyway, because most accountants tend to struggle with complex financial statements of publicly traded companies. So if the accountants and the investment managers and all these super smart people struggle with the ins and outs of any one particular company, why should I, as an investor, think that I know better than them? When the alternative is for you as an investor to buy a tiny slice of 500 or 1,000 companies for just a few £100, and then you'll know that whatever happens in any sector of the economy, in any part of the world, the risk of any of those individual companies going bankrupt and then that derailing your entire investment philosophy is minimised. I'd say that's quite a good way to start investing. And it seems Warren Buffett agrees. Thanks for watching this video, guys. If you found it useful, be sure to subscribe to my channel and hit the like button. I'd really appreciate it if you could do both of those two things. So in my next video, I'll tell you precisely how to construct a portfolio of index funds. I'll tell you which platform I use to do that. I'll tell you which some of my favourite funds are, and I'll tell you what proportion of your portfolio you should allocate to each investment fund. All of that and more in my next video. Between now and then, be sure to like and subscribe, and I'll see you in my next video.